Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 23rd, 2023. I've told you last week that my intern has come up with the idea and doing the research for me on one idea, one thing that happened economically or financially in our country this past week. And so this is, the last week, the Federal Reserve decided to pause, to not raise interest rates, and the markets had a reaction to that. This week they're meeting in Jackson Hole, Wyoming. It's called the Jackson Hole meeting or conference, and it's a big deal. And then in Friday, Wednesday, Thursday, Friday, and then Friday, that meeting ends, and Chairman Powell will have comments that came out of the meeting. So I thought I would play a piece. This is so well done. Following the announcement of the Federal Reserve holding interest rates, Bloomberg, Jonathan Farrow interviewed Mohammed El-Erian and asked for his take on it. I can't do it justice the way Dr. El-Erian does, so I'll play his clip. He gives 4 reasons why the Federal Reserve is boxed in the corner and why it's going to be difficult for them to raise interest rates, even though they've said they need to, that we've got a lot of headwinds in the economy, and there is a reason to raise rates, but the impact is going to get felt in the economy. So he gives those 4 reasons. Take a listen to Dr. El-Erian.
Mohammed, from your perspective, what's behind this monster move, not just of the last week, but the last month?
In order of importance, John, supply, first and foremost, followed by a revisiting of the growth prospects to stronger growth, followed by a recognition that inflation may be sticky over the longer term, and then finally, people are keeping an eye on what's happening in Japan. So you've had these 4 things come together. Supply has been the main drivers, and the others have contributed.
Mohammed, given the reasons you offer, are there also reasons to believe then that these kind of levels are sustainable?
Yes, John, but a lot will depend on what Chair Powell decides to do next Friday. And he has a range of choices. He can talk about short-term monetary prospects, he can talk about longer-term monetary prospects, or he can punt both and focus on some of the challenging economic issues facing the U.S. economy. But what he says is going to be critical in terms of what it does to the bond market. The other thing to keep an eye on, and you've mentioned it, is China. I don't think people recognize enough that you've had 2 long-standing problems coming together. First, pockets of debt and leverage becoming systemic. And second, an inability to generate high and genuine economic growth. And suddenly, these 2 things are merging and risking financial instability a la Chinese. And that's something to keep an eye on as well.
Okay, now I'm going to jump into my analysis on the market. For the past 3 weeks, the market has, generally speaking, gone down. And I'm going to show you some detail around that. The 3 weeks, so this is last week I'm going to show you now. When you look at the yellow box, you can see the results of the 6 major indexes that I'm tracking, actually 7. 6 equity indexes. There would be 4 from the US, 2 foreign, which would be developed and underdeveloped countries. And then the 7th would be the long-term government bond index, tracked by the ETF TLT. They all went down 1 to 3% just for last week, making the 3rd week in a row. The year-to-date numbers are in the pink box. To the right of that, the NASDAQ 100 still up 34%, the S&P up 14%, and then developed markets, small cap, et cetera, go on down from 6% down to 1%. And then bonds, long-term government bonds, TLT, is down 5.8% year-to-date and 1% for the week. They have been incredibly weak, and I'll show you detail on that later. To the right of that, you see where are these indexes relative to their moving averages. And 3 weeks ago, before this started, everything was green except for bonds. Bonds were still negative. I think they may have had one green dot, but bonds have generally speaking been negative. And so now the majority of these indexes relative to their moving averages, the take is much more negative, and still some positives out there, but it's weakening pretty fast. Then when we take the S&P 500 and break it apart, we see the same thing. So now these are all equities. So we've got equities all the way from technology to energy. And you can see in the yellow box, they are all down, anywhere from 1% to 4% for last week. And for the year to date, most of them are up modestly or negative. The two that are quite positive are consumer discretionary and technology. Yeah, 5 of them, 5 equity indexes are negative year to date. And you can see from where they are relative to their moving averages that, you know, the 20-day, the 50-day, and even some are going over into the 100 and 200-day moving averages and starting to even drop below those. So pretty negative report as the third week in a row. This is a chart of the S&P 500 saying what I've just said to you. So this is an 18-month chart, and you can see about in the middle of it is the beginning of 2023. So things in general have gone positive, a lot of up and down, but I put a circle around the last 3 weeks. You can see how far it has come. Now this is the 20-period moving average, not the 20-day moving average, because this is a weekly chart, not a daily chart. But in general, it's still up. But when you look from at the beginning of this year until now, yeah, up and down, but that is starting to take away some of the gains from this past year, or from so far this year. Now I want to show you a picture. Do you see that circle I put for the last 3 weeks at the very end of the chart? Now I want to take that and create an entire chart just around the 3-week period. And I'm going from a line chart over to a candlestick chart. Now, you may know about candlestick charts or you may not, but if it's red, then that's the degree from the open to the close that it went down. If it's black, then that's from the open to the close that went down. Most of these days in the last 3 weeks have been negative. They've not only been negative, but they opened at a certain price and went down to another price. So take a look at this. I think there's like one exception where it went up from the beginning of the day to the end of the day. But the rest of the time, look at that. These are about 15 days, 3 weeks. That's what the market has done. And that is the 20-day moving average. And they have crashed through the 20-day and the 50-day moving average. So that's the view. Is it going to go back up? Yeah, at some point it will go back up. Is it going to go down further? My opinion is it probably will, but I don't know that for sure. It's just that kind of trajectory tells me that's a lot of acceleration to the downside. When that happens, it typically has further down to go. Value versus growth. Growth stocks have generally speaking been in favor. Growth is a numerator, value is denominator. So when this goes up, that favors growth. When it goes down, it favors value. So last week it favored growth, and year to date it has favored growth. But over that period of time, some of one and some of the other. The S&P 500, I'm comparing it on a relative strength chart, also another relative strength chart, showing the degree to which the large companies, large cap companies, are doing relative to small cap companies. And the ETFs I use are SPY for large cap and IWM for the Russell 2000 small cap index. SPY is the numerator, IWM is denominator. So when it goes up, it favors large cap. When it goes down, it favors small cap. You can see that generally speaking, since February, that this has favored large cap. I've been talking about bonds. Bonds are weak. You can see on the left half of the chart last year, bonds got creamed. Government bonds got creamed. This is the long term, but so did the short term and the intermediate term. They all got creamed. And then this year, you can see from the black arrow, they're weak. They have been falling, and I think I showed you the number. It's down. They're down over 5% year to date, and still showing weakness. How far down are they going to go? I don't know. That tells you interest rates are going up, and the price of bonds and bond funds are going down. This is not good news for traditional advisors and traditional 60-40 stock bond portfolios. Stocks have their own kind of risk, but when you try to couple them with bonds, and this is happening, it's not the same as last year, but I will just tell you it's negative. And there are people who are sitting on negative gains, or I should say losses, for this year, or very modest gains for this year because of this. The dollar is starting to show some strength. It went up and then it corrected, and now it looks like it's moving back up again. The gold is showing weakness. It has come down. It's below its 20-period moving average, and it also is below its 20-day moving average. So I draw an arrow to show what I think is the direction of gold, measured by the ETF GLD. Silver, same thing, except it goes up and down a lot. It exaggerates these moves, and it has a longer term upward trajectory, and short term it has also been in a downward trend. Bitcoin has gone up this month, and now it's in some kind of a pullback right now, but year to date it is negative, and we have a Bitcoin model, and so it's tactical, so we have been out of the market most of the year, and we're out of the market now, waiting for a more strategic move up. The volatility index, and this is because last week was a volatile week, mostly because of the Fed action, but when volatility goes up, it generally means U.S. equities are going down, and the arrow at the end shows you the direction of volatility. It's going up. Asbury Research, they measure, they have Asbury six indicators, and again, 3 weeks ago, all of these were positive. This is the third week since that time, and now they are all negative, showing, again, weakness in the market. As of last Friday, they do a comparison, a relative strength comparison, showing how does one component in the market, one type of asset, do relative to another, called a cross-asset relative performance. And those that have three green sections, meaning the last week, the last month, the last quarter, low volatility is doing better than high volatility or high beta. Low volatility would be things like consumer staples or utilities or healthcare, things like that. Large cap is doing better than small cap. We saw that. Blue chips, meaning the Dow Industrials, are doing better than the broad market, the S&P. And that's measured generally by low volatility stocks. Value, same thing, Dow value, doing better than growth. Emerging markets are doing better than U.S. in the last week. and U.S. has done better in the last month and the last quarter. Government bonds have been doing better than corporate bonds. No matter how bad government bonds are, and I've shown you that, no matter how bad they are, corporate bonds are doing worse. And short-term treasuries are doing better than long-term treasuries. And when you measure the U.S. versus the world, not dissimilar from last week, two countries that are outperforming the U.S. And the U.S. is not measurably outperforming the other countries. 21 countries and regions, Malaysia and India, doing better than the U.S. the last week, the last month, the last quarter. Okay, jumping over to gold and silver. As of Friday, the spot price of gold was $18.98. I told you it came down some, continued to come down some. It's minus 1.3% from the previous Friday. Silver, you remember that silver chart, there was a little tick up at the end that showed a very slight gain, and it's 22.86 on the spot price, up 0.3% from the previous Friday. Gold-silver ratio is 83-1, favoring silver being a better value or a better buy. Silver is, you can buy it by an ounce of pure silver, or almost pure silver, and you can buy it by the tube, and generally there's 20 in a tube, or you can buy it by the monster box. That's 500. This is a monster box full of tubes. And the cost of a monster box has come down. You remember that chart on silver has come down from around 14,000, just above 14,000, all the way down to 12,530. And the spot price, I've already shown you that, and the markup is 220. That's been coming down. That's common for the summer because sales are usually slower in the summer, so it's not unusual to see spot price come down. And so that makes the cost per round in a monster box $25.06, and if you buy it in a tube, it's 50 cents more per round, or $25.56. Source of my information is my son Preston, who's in the precious metal business. So as this guy is reading the paper, looking at the crash of China, China is in terrible trouble, and down 7%. Wow, and imagine if they just told us the real story. Not just China, but the U.S. too. Thank you for watching. If you have questions or comments, leave them in the comment section below.